Hello, risk takers. This is your worst podcast host, Andrew Stotz from A Stotz Academy. And today I'm continuing my discussions with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his episode 645. Larry understands the world of academic research and investing so deeply. Today, we're going to discuss chapter 3 in his book, Enrich Your Future, Those Keys to Successful Investing. We're going to be talking about chapter 3, Persistence of Performance. Larry, take it away.
Yeah. So one of the things that's probably a strongly held belief, and for logical reasons, is that people who are successful, it's not likely a result of luck, but a skill if the performance is persistent over periods of time. Someone who's a great baseball player for 3 years is very likely to be a great baseball player for the 4th year. Same thing of other sports. And so people assume that successful active managers must also be the result of their skill and not just luck. And the problem is that we have a very, very, very different form of competition when we think about games or events where you have one-on-one competition versus what is the game of trying to outperform the market, where you're not competing one-on-one, but where you're competing with what's called the collective wisdom of the market. So let me explain what I mean by that. I'm kind of a high or middle 3.5 level tennis player. If I play against a low 3.0 player, someone who I'm just a bit better than, I typically will win fairly easily most of the time. 6-1, 6-2, maybe I'll lose once in a while, but most of the time I will dominate. And if I play up a level, against a 4.0, they're going to be not that much better, but better than me. And the reverse will be true. I might win once in a while, but they're going to win 90% plus of the time. So when you have one-on-one games of competition, like chess, for example, you have two players who are rated fairly close in chess with match points. The one who is the higher ranked player will normally win the vast majority of the events. And the way to think about that, really, I think the best example that I came up with is in tennis. So think about Roger Federer was probably the greatest player of tennis of his era before Nadal and Djokovic came along. And the three of them are generally considered the greatest players of all time. Now, we know you're playing in a Grand Slam tournament, you're playing against the top 128 best players in the world. And he never lost a single match in the first round in a Grand Slam tournament. Never. Despite the fact he's playing against such great players. But he's better than that. Now, he may have lost the second round match once. I don't know. But maybe he gets to the quarterfinals and maybe he lost 20, 25% of the time. And then he got to the semifinals. Competition's now tougher. He's playing against one of the 4 best players in the world, likely. And now he maybe loses 33% of the time. And in the finals, maybe he lost 40% of the time, something like that. So you could see that as the competition got tougher, it got harder and harder for him to win. All right. So there are 2 things that we want to talk about here. So first is the difference in one-on-one competition. When Roger was playing against Djokovic, or Nadal is playing against Djokovic, their competitive skills are so close that the match could be determined to a great degree by luck. That somebody shot, hit the tape, and just dropped in, or the tape caused it to go long, or someone missed the line by a hair. The matches are so close. Maybe the wind blew a ball slightly, etc. When the competition, the skill level is that close, luck often determines the outcome and not necessarily the higher levels of skill. Okay.
That's
In
totally,
that,
totally makes sense. And I always say in like CFA Research Challenge, when the finalist student teams are competing, it's like, truthfully, the outcome by that time turns out to be a lot of luck. You know, depends on the company they're presenting and whether a judge knows this, what they said, you know, that type of thing. And that's interesting. One of the other questions I have for you is that if we take those three top tennis players of today and we compare them to the three top tennis players of, let's say, 30 years ago, has there been an accumulation of learning that's been going on? So not only are they the best today, but they've accumulated maybe physical characteristics are one aspect, but then the other part is an amount of learning about training and about peak performance.
that's a really interesting point. I would say this. First of all, you can't compare today to 30 years ago because they're playing with much better technology. The rackets are much better than, you know, the wooden rackets that Bjorn Borg and McEnroe were playing with in the 70s. So, you know, the greatest players in the world today wouldn't look like the greatest players then. The matches, if you watch a Borg McEnroe match, the pace of the game is so much slower than it is today. But the players today have much better training methods. The physical training is much better. Understanding of diets and physical therapy and stretching and all of the important training, weight training and running you do, they're in much better condition. You know, McEnroe never, I think, won a Grand Slam event after 25. And Djokovic and Nadal and Federer were winning well into their 30s and mid-30s because they're much better. But that's an interesting point. Remind me, I want to come back to that because that is something that's very relevant. Okay. And that shows you how tough it is to win. When Nadal was playing Djokovic, very hard for either one to win, even though they were the best player in the world because the competition is so tough. So let's go back to this issue. So let's talk about Barry Bonds, who was generally considered, whether he was aided by medical technology and hormone treatment and stuff like that, is another story. But he was certainly the best hitter of his generation. Okay. And he was stronger than most hitters, but not stronger than all the hitters. He had quicker bat speed than most hitters, but not all of the hitters. He was one of the fastest runners of the game early in his career. He was a very good fielder, or had tremendous power, but he wasn't the best at any one single thing. But what you have to remember about Barry Bonds was that he was competing one-on-one against a pitcher. And Barry Bonds managed, let's say, to bat 300 in his career. I don't remember exactly what he did. But imagine if he faced a pitcher who had Sandy Koufax's curveball, generally considered the best curveball ever, Christy Mathewson's screwball, or Carl Hubbell's screwball, Walter Johnson's fastball, Greg Mattis's changeup, etc. You know, all in one person. Barry Bonds might not hit 300. He probably would hit 200 or 180 or something, and never would have hit 750 or whatever home runs he managed to hit. He was competing one-on-one. When stock pickers are trying to compete against the market, or outperform, they're not competing against you or me, or even Warren Buffett, which would be tough enough to outperform Buffett or Peter Lynch or any of the other great fund managers. They're competing against the collective wisdom of the market, as if Barry Bonds was competing against a pitcher with Sandy Koufax's curveball, Walter Johnson's fastball, Greg Mattis's changeup, etc. That's one of the competition is much tougher. And to bring in your point, 30 years ago, when my first book was published, Charles Ellis had written at the same time his book, Winning the Loser's Game, and he pointed out that 20% of active managers pre-tax were generating statistically significant alpha. Now, that's still a loser's game, especially after taxes, where that number would be more likely to be 10%. But the competition is so much tougher. 30 years ago, most people who were doing stock selection may have been a trained, coming out of college as a lit major or an art history major, and they went to work for Salomon Brothers, got trained. Today, everybody who's managing money pretty much has got a PhD or an MBA in finance for a top university, has the best data available with high-speed computers, and you're working with teams of other brilliant PhDs. I mean, the head of research at Avantis is a rocket scientist. And, this is literally,
rocket science.
I mean, that's literally what he is, a rocket.
Yes, it is.
And the same thing is true of people at Dimensional. And my co-author, Andy Birkin, who heads the research at Bridgeway, also has a PhD in physics and has won the NASA award for the best software of the year. These are people with likely far more skills, smarter than you, and they're spending 100% of their time doing it. And they can't win because the collective wisdom of the market is so, and the competition is so tough. That's the problem that active managers have. And the result has been that by 2010, Gene Fama and French took Ellis's data, renewed it, and found that less than 2% of active managers were generating statistically significant alphas. And that was less than you would expect randomly by chance. So that's what you have to recognize. If you think you're smart, maybe you're a bio, engineer, and you're studying a company and you think you've got an insight into what's happening. Well, maybe you have insights that could allow you to exploit you or me if we were competing one-on-one. But you're not. You're competing against the brilliant scientists at Renaissance Technologies and lots of other, hedge funds and high-frequency trading funds that are paying multi-million-dollar salaries and have the best computers and the best databases, and now artificial intelligence to scan, financial statements better than any human could do it. And they're all going to have that same data. How are you likely to get this advantage to give you a likelihood of winning that should say you should try to play the game? I just don't see how it's likely.
So to summarize what you're saying is that in the world of finance and investing in the market, every time you go to trade, you're trading against the collective wisdom of all the best people. And you also in this chapter talk about how majority of the people trading are institutions. So it's not like you're just trading against the smartest, Tom, Dick and Harry in the market. You're trading against the people that have the real resources. So that's the first thing. And the other question I have about that though is, does that mean that nobody outperforms outside of luck?
No, I wouldn't say that. There's probably a Renaissance man somewhere who gains an edge, figures something out, maybe creates an artificial intelligence program that can read data, financial statements. There's always new research coming out. In fact, I write up new research all of the time. I just wrote up a new paper, which I thought was really interesting, that shows the size effect, which is small cap stocks tend to outperform large stocks over the long term, really isn't a size effect. It's a merger effect. So what he did is I went into the data and said, can I identify characteristics that predict that a company is likely to be taken over? And if I buy those companies, I will gain that size premium. and he found it totally subsumed the evidence of any size premium.
That's fascinating.
So the key then is that person could outperform, but soon as that paper gets published, even before it gets into a journal, people like me and the guys at, high frequency trading like Renaissance Technology and others, they're reading these papers, they're going to implement it, and the advantage goes. That's what makes the efficient market hypothesis the most powerful of all theses. It's that the very act of discovering these anomalies makes the market more efficient, because the act of exploiting the anomaly you discover eliminates the anomaly.
So is what I'm hearing you say is that maybe the only way that somebody could persistently outperform for a period of time, it won't last forever, is if they find something that the market hasn't yet recognized, and then, or they've come up with some little advantage, and that their success will ultimately, through their trades and their assets under management, will ultimately feed that information into the market, even if it wasn't published through academic research, and the market will adjust to that.
That's exactly what happens. There are people who worked at Renaissance Technology and then leave to go say, well, I don't want to work for Simons, I want to make my own fortune. And they take their knowledge and they go somewhere else and try to replicate. And the other problem is that there's no doubt there are very strong diseconomies of scale in investment management. So if you're successful, what happens? Assets come in, very few managers are willing to turn away the fees. And now you have to look either more and more like the market, and your higher fees make it difficult to overcome those expenses, or you have to take bigger positions in those same few stocks, which means your market impact costs are going to go way up. That's why the phrase I use, and I've written in my books, is that successful active management contains the seeds of its own destruction. And that's why one of the reasons why you don't see persistence, besides the other things that we have talked about.
And so one other question I had about that was, I have a friend of mine, and he invests in the Thai stock market. And what he looks for is, because he's managing his family's money, he looks for relatively illiquid companies that nobody's really, trading in. He may try to get blocks of the companies, and he's got a super long time horizon. And he's not looking for price appreciation. He's trying to look for companies that are going to generate dividends and generate good returns over a long time. And maybe the price will go up, maybe it won't. But so he's built a position in, let's say, 10 companies. And his argument to me, and I think it's a valid argument, but I may be wrong now that we're talking, but his argument is that I'm taking advantage of an anomaly in the market that most people will never take advantage of. They can't, an institution can't do that in these types of small companies. And he's built a portfolio of, let's say, 10 small illiquid companies. It doesn't even have to be small. Let's just say illiquid companies that he's holding over a long period of time. Is it possible that he could outperform from that?
Well, one, I would expect him to outperform, because he outperformed the market because he is accessing an illiquidity premium. Stocks that are less liquid, right, have a illiquidity premium because the big people can't invest in it, or they're afraid to invest in it, because if they want to get out, they'll move the market against themselves big time. And when they're trying to buy, if they buy a few shares, the price runs up and it runs away from them. So it's very difficult for them. So there is a well-documented illiquidity premium in stocks. The problem that I have with his strategy is concentration of risk. We know, as we've talked about in prior episodes, most stock returns, or the excess returns to the market, come from a very tiny, small percentage of stocks. So we know in the US, it's 4% of all the stocks account for 100% of the excess stock returns. So
that's incredible statistics.
If I own in the US say 500 of these illiquid stocks, I've got a pretty good chance of capturing that illiquidity premium.
Mm.
And if I also use the investment knowledge from my books that are academic research, you not only buy small, illiquid, but profitable companies with low financial leverage, low operating leverage, lower prices to cash flow, which it sounds like he's doing, then I'm accessing those premiums and I'm likely to outperform the market. Maybe not on a risk-adjusted basis, but I'm likely to get higher returns. So my way of investing is I do what your friend is doing, but I'm investing in mutual funds that own anywhere from maybe 300 to 600 of these companies or more. Of course, the US market is deeper than Thailand. So my only concern about the strategy of your friend is he's taking a lot of concentration risk, which I would prefer not to see. It increases your chance of hitting the home run. It also increases your chance you're buying a company where somebody's going to commit fraud and steal and this, you can have negative effects. You get lawsuits. I mean, lots of bad things can happen.
And the difference,
so that would be the problem.
And the difference in Thailand is that we don't have a fund or an ETF that can really access that part of the market. But I notice in the back of the book, in your appendix, you've highlighted things like small plus value plus momentum plus profitability and quality. And for US, there's different funds out there like the AQR, small cap multi-style, the iShares Edge, MSCI, multi-factor are two that you list. And I mention that only because for the listeners out there, the resources in the back of the book are fantastic. But is that it's fair to say that in the US, you can get closer to replicating or capturing that potential risk premium because there are instruments available that really in somewhat smaller markets like Thailand, you're just never going to get.
Yeah, and I would add this. There's some trade-offs here. The more you concentrate, the greater access to these premiums you have because the premiums are greatest in the smallest of stocks. So the more you diversify, the more you reduce the tail risk. So the question is, where's that medium in US stocks? I probably want to own at least 200 or 300. And probably not much more than, I don't think you need to own much more than 600. Yep. If you're having to own more than that, maybe your fund's getting so big, you need to own more of it. And otherwise you have those market impact costs. So Bridgeway Small Value Fund has fewer stocks than Dimensional Small Value Fund. They're both very good vehicles, but Bridgeway gets you more exposure to those factors, deeper exposure to the factors, and you're going to have more volatility and wider dispersion of returns, but a higher expected return, but not necessarily a higher risk-adjusted return.
Yep.
You have to pick your poison, if you will. Do you want more diversification and less tail risk, or do you want higher expected returns, but more tail risk and wider dispersion of returns?
So there truly is no free lunch.
Well, there is a free lunch, and that's diversification, but only if you do it properly. Owning 10 different tech stocks is not diversification.
I want to end this by talking about a visualization for those people who are not familiar with American baseball. When batters are warming up, they're swinging their bat and they're getting ready, they're loosening up. And then we have something called a donut that they put on the bat that adds weight to the bat. And that's good for when you're warming up. The bat's pretty heavy. But could you imagine if a batter had to go up to bat with an extra weight on that bat? And I think what you talked about in the book was that extra weight is the weight of all the costs of an active manager versus a passive manager that walks up without a donut on his bat. But maybe you can explain that.
Yeah, I'm so proud, Andrew, of that analogy. That's great. I wish I had thought of that one. That's exactly right. You just have this extra hurdle to overcome. Imagine if Barry Bonds had to swing his bat against a 100-mile-an-hour fastball with a 5-pound weight on his back. He wouldn't hit 150, let alone 250. So that's one of the disadvantages. And so the reality is active managers fail with great persistence, not because they're dumb. They're very smart in general. It's just that they have a burden of costs, which makes it very difficult for them to outperform and overcome those costs. Even though there are some anomalies in the market, it's just that there aren't enough dummies like you or me to exploit, right? Who are trading based on, who knows what, but it's not good research, something they read in Barron's or something, or hear Jim Cramer say, right? Yep. Or they think they know more than the market without ever asking, gee, I wonder if Warren Buffett knows that, right? As we've talked about.
And to summarize the costs that an active fund manager faces, you highlight there's costs related to kind of operating the fund, which is research expenses and just fund operation costs. Then there's market impact type of funds costs like bid offer spreads, commissions, market impact costs. And then there's
for your
taxes.
Listeners, just so if they're not familiar with market impact costs, let's say a small cap stock is trading at 10 bid, 10 and a quarter ask. Now you could buy 100 shares or maybe even 1,000 shares at 10 and a quarter. Go try to buy 50,000 shares. Maybe you get the first 2 or 3,000 at 10 and a quarter. Now the market sees you're trying to buy a lot, and the next 5,000 shares you get at 10 and a half, and the next 5,000 at 11, and you drive the price up. And when you're finished buying your 50,000 shares, the stock drops back to 10 bid, 10 and a quarter ask. That's market impact cost.
Yes. And some of us aren't so rich to have market impact, but the big institutions definitely have it.
Yeah, that's a big advantage that individual investors have, is they don't have, typically the average individual investor doesn't have market impact costs, but they don't have the knowledge and the information that the big institutions have. So their winning strategy is just don't play. Just take advantage of these well-documented factor premiums that Andrew Birkin and I wrote about in our book, Your Complete Guide to Factor-Based Investing.
Yeah, and it's one last thing I would say about Asia, in particular Thailand, but I know it's happened around Asia, is that there's one place within the market that's been competed down to very narrow cost, and that is the cost of trading through brokers. It used to be very high, and now it's minuscule. So for the average, if someone was a knowledgeable person, they can access the market at a pretty low, commission rate. What were you going to say?
Yeah, I just want to add one other thing. I'm glad I thought of this point. A lot of people think, for example, that small caps, the markets are less efficient than they are for large caps. Why? There are, 100 analysts following Google or Microsoft or Tesla or whatever. And maybe you got XYZ fried chicken franchise that's in 3 states and whatever, and there's one analyst following. So there's less information out there. Well, yes, that's true. And maybe that allows you to capture information the market does not have. The problem is the bid offer spreads are much wider and the market impact costs are much greater because it's an illiquid stock. And that's how you get this balance, right? The more efficient the market gets, the harder it is to win, but the trading costs are lower because the market's efficient. Well, the evidence is in small cap stocks where people think it's less information efficient, active managers do just as poorly. The same thing is true about your friend in Thailand and emerging markets. People think emerging markets are highly inefficient because there aren't as many people following them, but active managers fail with great persistence in emerging markets as well, proving the point that it's not, that markets are informationally so efficient that active managers can't win. It's that there are costs to exploit those inefficiencies. And the more inefficient the market is, the more the implementation costs weigh you down. And that's the problem there. So you have to have an inefficiency and very low costs in exploiting those inefficiencies.
So much in this tiny little chapter. I appreciate it, Larry. I want to thank you for another great discussion about creating, growing, and protecting our wealth. For listeners out there who want to keep up with Larry and see what he's doing, follow him on Twitter at Larry Swedroe and also on LinkedIn. I know I follow everything he posts. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.